Good morning, members. I'm a little bit early here, so for those who still are to join, I'm gonna probably take a couple minutes and chat with y'all, and then we'll let them join. I expect maybe, I don't know, 30, 40 people probably from what responded. Maybe it will be that much, maybe it won't. I've never done this, so I have no idea. So we'll just see how it works out. Can you hear me well? Or can anybody hear me? Hopefully somebody is registered so that they can give me feedback. All right, perfect. Okay, so I'm going to try to spend a couple minutes here to see, if anybody is late coming in, so I don't really start the show. What I wanted to do was to kind of start with the portfolio, just an overview. I'm not going to send out videos this week because I'm going to kind of cover it here in terms of what the market's doing. If I go in and I look at the open positions on the Premier, in this particular case, let me pull this up a little bit for now. In this particular case, I moved away and moved into gold stocks mostly with the latest round of things. I like that space. I think it has a chance to work higher. Gold itself is struggling, but the stocks are trying to outperform. I'm not bearish on this market. I can't be bearish because the trend is up. But on the flip side of that, I grow more and more cautious the farther we go without any kind of significant retrace. And as most of you know, I tend to be more cautious than I am exuberant most of the time, and that's just a characteristic of myself. I mean, some people are gung-ho, they try to make everything on one trade. I'd much rather make it over time in a slow, deliberate fashion without drawdowns. And I'm going to talk about that here in a minute as we get started, but what I wanted to say is that there's nothing in this portfolio or in the investor's portfolio that I really want to kick out. The only one might be GNC, right? This one just can't get going, but it still hasn't done anything wrong. It's still holding up. So, it's not as if I'm trying to get rid of stuff. I believe that we need to simply let this market play out as long as it wants to. I believe it's going to get harder now. The calendar's changed. I think we're going to notice what's going on elsewhere, and I'll talk about events and big picture kind of stuff here in a second. But just from a portfolio perspective, I'm not bearish, yet I'm not willing to jump into more stuff at this level. I'm just going to try to work in, if this market, we just got that S&P high. I suspect you're going to see some carry through Monday, potentially Tuesday. I fully expect that. The real question is what does it does after that, right? Will it push higher? Will it not? If it does, if it can start to pull away again, then that was a consolidation with a breakout that's going to hold, and that can carry again for another 10, 15 points on the S&P, and maybe it will. I don't know. So we don't want to abandon the long side, but at the same time, I don't think you want to get exuberant up here. All right, so that's the general thought. Let's go into, now I have kind of a scattered approach today. I did take some notes, and I do have a little bit of a drive, but I had a lot of notes come back from you, and I want to try to work through those notes as best I can. I ordered them a little bit to try to take them in order, but I suspect I'm going to jump around a lot. So hopefully that won't be too distracting, but at the same time, I want to try to cover most of what you said, and I'm only allocating about an hour, so if it takes longer than that, then I'll take and do another show. All right, so let's get started. So big picture. So the first thing, y'all, a lot of the questions were generated around how do I approach the markets? What drives my thought? And one of those big things is do you, as an individual or a trader or whatever, does one look at the big picture from the perspective of top down or bottom up? How do you approach the market? And what I mean by that is if I go into like the current market trends, and I'm looking here at the general market, and then there's the sectors, and then there's the stocks within the sectors, right? And so the question to me is like, and to everybody is, do you look at the big trend and use that to drive your decisions, or do you look at the sectors, or do you look at the stocks? In other words, top down, general market down to sectors, down to stocks, or bottom up, stocks to sectors to general market. Well, I'll tell you this, when the general market is heading down, there's a high correlation between the general market, the sectors, the stocks. In other words, what is it that the rising tide lifts all boats and it sinks them too? I mean, that is true. There's a high correlation from a qualified trend perspective. There's a high correlation between the direction of the general markets and the sectors and the stocks. If the general market is weak, you're not going to find a bunch of strong sectors and you're not going to find a bunch of strong stocks. If the general market's strong, you're not going to find a bunch of weak sectors and weak stocks. I mean, that's just the way it is. And it's a self-fulfilling, plan, because if you think about it, the general market is a composite of the sectors, right? These sectors make up the general market. And within the sectors, there's stocks. And those stocks make up that sector. They're weighted differently depending on what they are, but they all have that inherent correlation, right? So when you ask the question top down or bottom up, it really is top down gives me a view of what's going on, but bottom up is what drives everything. In other words, if I start to see deterioration in enough stocks in a sector, then that sector is going to deteriorate. The same thing with the sector. If enough of those start to deteriorate, the general market was or will. If you look at what I look at on a daily basis when I do like TATV, my process is what is the market doing? What is the sectors doing? What are those auxiliary indexes doing? Right? Because those are the main things that drive what happens next. I don't go look at individual stocks because you're getting into too much minutia. So the best place to look is to look at the sectors. When the sectors start to break down, the general market will. Or when the sectors turn and start to move higher, when you're in a bear market, the general market will follow. And matter of fact, when the sectors move in a bear market, typically the general market moves right along with them. It happens fast. And the reason for that is the weighting structure. Because typically when people feel that the end is there, right, on a bear market, they're going to move a lot of money into big names. Those big names like, let's just take the XLF. What are they going to buy? Well, you're not going to go buy the little bitty stocks first. You're going to go buy the big ones. You're going to buy the JP Morgans, the Wells Fargos, the Berkshire Hathaways. That's what you're going to buy. Those are the largest weightings in the sector. So as soon as those get bought, they move the sector moves the general market, and it all happens very quick. That's why bottoms usually happen very fast. They're not a process. They're usually a very quick event, right? At the top, it's very different. You slowly see deterioration, You slowly see the individual stocks start to roll over, which eventually leads to the sectors rolling over, which eventually leads to the market rolling over, right? So it's the same process, it just happens at a different speed depending on which way you're going. Okay, and I've looked at a lot of these ups and downs over the years, and it's fairly consistent. That's the way it happens. Not always, but almost always, right? Almost. So the question of top down, bottom up, well, it's really bottom up, right? But it's too hard to look at the individual stocks most of the time. You only want to focus on them when things start to deteriorate. Then you start looking at those individual stocks. You know, sometimes I tell folks when they ask me about an ETF, I said, what's the weighting inside of it and what's the big ones in it doing, right? In other words, if I wanted to know what the XLF is going to do, I should go look at the 4 or 5 largest stocks inside that thing and see how they're behaving, because they're the ones that will drive it for the most part. Okay, so that was one question. So that's so bottom up, down. I look at the top. You know, I look at the top, I look at the major sectors, I look at the OX indexes. That gives me a good feel for where the market's going short term. Which brings me to another question that was asked. So let me pop over here. So, let me find it here. So the question was, it had to do with whether, you know, somebody was asking 15 to 20 years. Okay, here it is, long term. So I know this is swing trading service. Well, yeah, it is, and yes it is, and no, it isn't. I have 2 portfolios. There's swing trading, and there's also the investor, which is a longer term time frame, which actually brings us to another thought. What's the difference between the investor portfolio and the swing trading portfolio? What's the difference between any portfolio? Usually it has to do with what you have in it, but it also has to do with what how you're managing it. What really distinguishes a portfolio is how much drawdown you're willing to take, right? How willing are you to take a 10% drawdown versus a 2% drawdown versus, you know, no more than 2% in a quarter or something? I mean, that's the distinguishing piece. Partially it's what you want to invest in. Are you going to be in, you know, stocks or bonds or some mix or whatever it is? A lot of times, you know, that's the whole diversification piece. But the other piece has to do with how much are you willing to risk. The longer you go out in a time frame, whether it's, you know, whether we're talking 2 days or we're talking 2 months, talking 2 years or 20 years, the farther you go out in terms of what you're investing, your horizon is, the greater the risk of drawdown, because you're going to want to err on the side of you know, you're going to want to try to follow the trend. Well, what trend are you following? You're following the long-term trend. We have these up here, and we got short, intermediate, and long. You know, this is just days, this is weeks, this is years. I mean, months, which, you know, ends up being about 5-6 years. If you're going to invest on this time frame, you're going to want to watch the intermediate term trend and the long-term trend. These are the ones that should worry you. When this one starts changing, you have to be worried more about this one changing, right? You will change here first. That will eventually lead to this. Eventually that'll lead to that. That's what I was just talking about earlier. By the time this changes, the market's already going to move 10-15% down. It's not going to happen right away. This takes months. Think about your bars. Let's go look at, let's pull up a chart here. So let me go pull up, let's use this one. So I'm going to go to Tools, go to TA Charts. And I'll put in, let's just put the SPY in. Okay, so if I put the SPY in, and here, let's start with this one. If I put the SPY in and look on a daily chart, okay, if it breaks under these 2 swing point lows, that's going to change trend. That's from 157 where we are down to 153. That's 4 points. That's not very far. Okay, if I want to change trend right now on the intermediate term time frame, and this will change here fairly soon, this will become the bar. But right now, I would have to trade all the way back to here, 139.54, 140. So that's what? That's about 16 points. Okay, so 16 points, that's, I don't know how many percent that is. What is that? 1% or so? It's not that far. If I want to change the monthly time frame, I've got to trade, and this is just to get it to sideways, all of these. But if I want to trade it, I got to get back to 127.14, right? That's another 20, so that's, you know, actually that's more percentage rise, isn't it? Here, my mind's not working. Let me do the percentage right quick. So if I got to trade $22 cheaper, and I'm on a 156 or so, yeah, it's 14%. To get back to here is 14%. Okay, that's just to change the trend to sideways. That's not even to make it bearish. To make it bearish, you'd have to break this one, right? So if you're going to invest on a long-term time frame, you have the obvious problem of timing, right? And the drawdown that results from it. Okay, so how can you alleviate that? And going back to the two portfolios, the way I choose to do it is I choose to say, oh, okay, I'm going to invest on this time frame, right? But I'm going to watch this time frame to tell me when to get safer, when to get more risky. In other words, if this starts to change, I want to get more safe. I even want to get more safe if this one pushes so far that it's not reasonable, right? That the probabilities are not reasonable that it continues. So when you're looking at it, what you can do is you can adjust, right? You can have a long-term portfolio, but that long-term portfolio is dependent on what's happening in the shorter terms. That's how you can control your drawdowns. How closely you manage that, right, has to do with how much drawdown you're willing to take. So if I'm willing to take a 2% drawdown, I'm going to have to manage it very closely. If I'm willing to take a 10% drawdown, then I'm not going to pay very much attention at all to the daily chart. I'm only going to look at the weekly, right? When the weekly starts to roll over and gets back into support and test here, and let's say that it bounces back off on the first retest region, pushes back up, everything's fine. I haven't changed anything. If I'm willing to take a 10% drawdown, there's no risk, there's no reason to, because it hasn't done anything wrong yet on that time frame. And I'm willing to sit with those kind of short-term losses. Short-term in the context of a long-term time frame. Okay? So when the question comes up, and I saw 2 or 3 questions related to this, when it comes up about how do you invest long-term, how do I know what the long-term is? You don't. You never will. You can't. The farther you go out on the time horizon, the greater probability that you will be wrong, right? And even if you're right, you won't be right for the reasons you think. It won't be the way you think it is. Okay, so the point is that if you want to invest in the long term, you can, but you do it using the shorter term time frames to guide you. I hope that makes sense. It's easier to say even than it is to do, right? Because you know, when this thing turns and it moves 5-6%, panic sets in, right? It always does, right? Because on a daily time frame, which is where we all live, on a daily time frame, which is where we all live, right? We live and breathe this time frame. Some of us live and breathe the intraday time frame, but on this time frame, a 5% move down, you know, you get back to 151 or something, that's panic time. I mean, the market looks very different there than it does here, right? It looks like I got an extra day in here somehow. Huh. Okay, I'll have to get that corrected. So anyway, so that's what you know, that's the way you have to look at a long-term time frame, right? It's a series of shorter-term time frames, and the key question you have to answer for yourself is what kind of drawdown am I willing to take, right? If I'm willing to take a 10% drawdown, I'm going to look at different charts than if I'm unwilling to take that. Okay, that's the key question you have to answer. If you were in there and you were willing to take a 10% drawdown on any particular time frame, then you probably were able to ride this thing most of the way up without taking very much precaution. Now, let's get to the precaution piece. So let's just say I want a 5% drawdown. On a 5% drawdown on a monthly chart, I would have had two areas of real problems, right here and right here. Okay, and if we go back and we put this on a weekly, I don't know if we can, yeah, we can see this one. So on a weekly, once we got up here, once we tested up here and we started to break down, and we broke a swing point low over here, right there, and that actually, if you go back and look at it, that was a break of multiple swing points on multiple time frames, which you always want to be careful about when those things set up. That would have told you I need to be cautious as soon as that swing point low broke here, right? And that bar actually changed it. So right at that price point, you'd want to get careful. Now, how do you get careful? The two primary ways that I believe work. The best is cash. You simply move more into cash. So if you're 60% invested or 80 or 90 or whatever your number was, and you're watching a 5% time frame, a 5% drawdown, that was your max. And I don't even know what this number is. Let's do the number right quick and see. So from here, 139 minus, and that low is 134. So that's roughly 5 divided by the 139. So that's a 3.5% drawdown here. Okay, when you get down to here, you're over your 5%. So if you're 3.5 down, you're more than halfway past. You're 3.5. You only got a buck and a half left on a percentage basis, and you're breaking multiple swing points on multiple time frames, which can be the signal for a, well, not can be. It has a high probability of being a signal for a fast move down. There's no reason to sit through that on that time frame when you're already 3.5 off the high and you get a 5% drawdown max that you're trying to adhere to. So given that, at that particular point, when that break occurs, you should be moving more into cash, right? And what you should be waiting for is for some sort of an indication that that bottom is in, and then you move back into it. And you had plenty of chances here after this was all over to do just that. That's the way that you have to trade those turns, right? Depending on what your drawdown max is. So when you get a setup that has a high probability of continuing, and the reason for that is that if you're right and the trend is going to continue, if you're wrong and the trend is going to continue back up, all you've lost is some time. Time is much better to lose than your money. So you lost some time. You're still in the market in case you don't get back in at a great price, but you have the potential to get back in at a better price or about the same price or maybe a little higher. That's the sort of thing you just have to, you have to judge it. Now, if you're right and the market really is crumbling, that you took off 20, 30% or whatever the number was and put it in cash, in that particular case, if this thing really does turn and head down, then you're going to, of course, you're going to be a wise man and you're going to be much better off because you're going to be able to buy back in lower. And as this thing continues to travel down, and the trends actually do start to change, let's say intermediate term goes bearish. This is intermediate. It would only went sideways here. Sideways says that it's a temporary space, right? When it turns sideways, that says that, hey, it can go back up or it can go down. That's the transition point. It simply says the trend is no longer bullish. Okay? At that particular point, you have to be more safe. You can do that right at the beginning of it when you see it's about to change on this particular case because you have a high probability of that. Okay? Hopefully that, that's a lot said, but that's the way I look at it. So if you're trying to minimize, the other way to do it is not cash. The other way to do it is to simply go over and buy some inverse ETFs. And I prefer that to cash in a lot of cases when you're doing this particular move. In other words, it's been bullish, right? Bullish, bullish, bullish. It starts to turn sideways. Now in this case, it didn't break a swing point low. until way down here. It starts to turn. I just want to move to ETFs to get safer at first, right? And then I want to start moving more to cash if it looks like it's going to continue. So to ETF, and the reason for that is usually your portfolio is going to be made up of individual stocks. It's very hard to get back into those, and if you're in good ones, right, and not these high, if you're not in a high volatility stock, a good stock that's, that has good prospects for the future, like the eBay was all last year and still is. If you're in a stock like that, you really don't want to totally get out of it, because that stock could turn and go right back around on you. What you want to do most of the time in a longer term portfolio is you simply want to stay in that, maybe whittle it down a little bit as you're scaling in and out, and start protecting it with an ETF. If for those of you, many of you have been in the Wall Street, so you see the TA Investor portfolio. In that portfolio, that thing's been up and running now for over a year. I think, and I'd have to go back and look for sure, but I think we've gone into inverse ETFs maybe twice over the last year. We've simply been long the whole time. Right? Now, we haven't been heavily invested. We scale in and out, and sometimes we take some off and we're less invested than others. But we haven't had the occurrence over the last year, and this is, that portfolio started back here in January. There really wasn't, it was actually, I believe it was right here is where we actually went in on inverse ETFs. And I don't think we did it up here. I think that was the only time we did. So, and that has to do with how you're trying to manage your risk and how much drawdown you're willing to take. That one's willing to take more drawdown than the short-term one. The short-term one's trying to time small trades on this time frame, right? It's trying to look at this time frame and trade it. So there's a big difference between the two. All right? Okay, so and that kind of leads into the whole thing about time frames. Time frames, there was a question about why not put all the, why not overlay daily, weekly, monthly charts, the support and anchor zones on the same chart. And the reason for that is it gets way too messy. In other words, I got to use a big coloring scheme, something, you know what I mean? It just gets too messy. There's enough information on here already, right? And there was a suggestion to highlight earnings bars. And that's not a bad suggestion. I just have to think about how to do it and get it on here, because I don't want to put too much on here, because the more you get on here, the more the more difficult it gets to make sense of it, right? Why do I limit anchor bars to 6 for wide price spread? Or why do I limit high priority support and resistance zones to 3 of each? Because if you get too many, it just becomes too difficult to make sense of it. I want to try to identify those areas on the chart where supply and demand are most significant. Like everything, the algorithm isn't perfect. It tries to model what those areas are, but it's not perfect. And I continue to look at it and try to enhance it as we go along, based on what I see. But I've got it reasonably well tuned. But there's always room for improvement. But it's not one of those things you want to go change every few days. You really want to think about it. You want to test it. You want to back test it, make sure it works. But the point is that you're trying to model where supply and demand is. This area, when I look at the SPY, for example, this makes a lot of sense. Let's just look at this together for a second in terms of this time frame, and then we'll flip to another one. Why is this important? Well, that was the swing point high. You've got 2 big anchor bars there, right? You had a breakout, a gap up breakout over the swing point high, right? All of that stuff, right? All of that stuff is important. It just so happens that the algorithm determines that and puts the zone right there. Now there is importance as well. Now there's 2 swing point lows aligned here. If this thing starts to turn and breaks these swing point lows, right, that's going to make a fast move, because there's going to be stops. Swing point lows is where stops, when they're really at the boundaries, that's where stops accumulate. Right? Swing point highs, same thing. Stops accumulate the longer they exist and the more that they're there. In this case, there's 2 of them. There will be stops down there. And when that happens, you can imagine that it's going to drive the price down real quick as they fire their sell orders, right? Their sell orders to protect the longs that people have. So when those stops fire, it's going to push this price down quick. It's going to push it right into the support zone. This particular chart happens to line up perfectly that way. And so that is a good area for where support should come into. Stops fire, you come down here, they exhaust themselves, you probably find yourself, you try to bounce off of that, especially the first time back, which has a high probability, right? A high probability of succeeding, in other words, to retest region. And so that looks good, actually. And another one down here, that one's okay, but you can see why with that big anchor bar. Now, let's go to the weekly real quick. And I haven't done this in advance, so we'll see what it looks like. Look at that. Now see, here's where the weekly takes up for the daily. The weekly's got the overlay at the swing point high, which this is going to end up being a swing point low fairly soon unless we really dive all of a sudden, right? Because we've already got 4 bars past it, and this is the 5th. Yeah, so we will have a swing point low here more than likely. Now that actually lines up to be a very interesting case if it happens, because you're going to have a swing point low there, and that's what price point is that? That's 148.73, and that's going to be down here, right? Okay, so now that area, swing point low here, there would be a low on this one, a low on the weekly. That's the area that if we break is a problem. You always want to look for how far you can come down to see where the real problem is going to be. That would be the area I worry about if we trade that low again. Okay, so that's what, 20 points down. So 20 points down is a key area, especially if we go on for another couple weeks up here, because that would make this a swing point low, and would also make it would also have a swing point low in this time frame, and you would have broken this. My guess is that what you're going to see here is you're going to see this market come back, it's going to hold, it's going to bounce, it's going to take some time. You're going to set up swing point lows here on the long-term time frame. You're going to have it here as well. If we're going to work lower, I would think that's the way it works out. You come back, you do some testing, you bounce on the first retest, you come back up, maybe you fell. If you do fail, you come back down deeper, and that's the real test, right? That's where the intermediate term time frames can change on you. That's where you have to protect yourself. Hopefully that gives you a good feel, and that's using the SPY. That gives you a good feel for how I try to look at charts in terms of where's my risk. Right now the risk isn't great. It's probably back to here. After we test that and bounce, if we do, or if we break down, that changes the risk scenario, because this is the big risk on a longer term time frame. Okay? All right. Well, that worked out good. One other thing that's important to continue to drive home. Trend is not a timing, right? It's usually not a timing mechanism. Now, there are cases where a breakout changes trend and is the timing, right? And that's the only case, breakout, breakdown, right? And that happens in those cases where you have multiple swing points broken on the upside or downside, right? Simultaneously across multiple time frames. And in that case, trend, quote unquote trend, can be an entry point. Most of the time, something like anywhere from, 62 to 80% of the time, a breakout comes back to retest and regen within 6 bars on any time frame. And given that, right, you usually don't want to buy breakouts. In that one case, or the case that I've identified, and if you look in the latest book, the steps are there, which is what Trading Tools tries to do, the signals, is to look at it and say, okay, what is the case where that breakout continues, and there identifies the high probability case for that. So trend typically is not what you want to use to enter and exit. Trend is to tell you which direction to be pointing and leaning for the most part, right? Anchor bars and zones are what you use for your entry and your exit. And you use them not just all in, all out, but scale in, scale out, right? Which gives you a higher probability of winning. Let's talk about, and I had another note here for myself. What drives a decision? And let's look at, I'm trying to think of, well, actually eBay had a big bounce on Friday. They had investors, they upped all their estimates, right? And I guess my programs ran last night, put double bars in, unfortunately, but I'll have to clean that up. Something else I didn't think about. eBay actually just set up an ABCD. It's coming into resistance now. As it came back into support, it held. Somebody had asked me on the show if I thought it would, and I thought it would. Big volume expansion, right? Just like you saw over here. Why? Because they raised all their estimates. All of a sudden, eBay's back in vogue. Okay, and it will probably do this ABCD up. What is it? Why do you want to use anchor bars and zones for your timing? Okay, let's review the three things that go into a high probability event. Three things govern what you want to do in terms of when you enter something and when you exit something, okay? Those three factors, and they're not in any particular order. One everybody talks about, and that's the reward to risk ratio. What is my risk versus my reward? So when it came down here, my risk is fairly high because I have no stops underneath it, right? I don't know how far it can go. Comes back up, now it comes back into a support zone. It comes into it with this bar, the support zone it's coming into, they've changed, these change over time, right? At the time, there was a support zone based on this bar and this bar. So your risk was underneath this bar, 50.62. And price came right down to it. Wasn't as high, the volume wasn't quite as high. It came back into support after breaking it, bouncing over it, and coming back. Given that, right, my risk reward is pretty favorable. In other words, I don't have to risk much. I can use this bar as my low at that time, right, when it was on this day. I can use that bar as my low. I can risk down to, somewhere in like the 50 area if I want to, or I can even go below this low if I want. And what am I shooting for? Well, I'm shooting back up for the resistance area. At the time, it was here, and then the higher one was up there. Given that, resistance here, buy it there. You don't have to risk very much. You're shooting for about a 1.8, right, on the reward to risk. That's one factor. What's the other factors? One factor nobody ever talks about very much is how long your money is at risk. It's, if you think about it, the longer, let's just say I buy 10 stocks and I put them in my portfolio and I turn off the screen and I don't look at them again for 3 months. Okay? What is my risk? Well, my risk is every day for 3 months something could happen. And the longer I'm sitting there with no alterations to what I have, taking profits or cutting losses or whatever, the greater my risk that event that's going to come along and affect all of those stocks, right? Remember, 80% of them move together. The greater the risk that that's going to happen, right? The longer you let them sit there, the greater the risk that the black swan, if you will, comes along and takes your money. So you don't want to just sit there forever, right, without doing anything. You want, ideally, you want to be able to figure out when to come in when the probability is the greatest that whatever you think is going to happen soon, right? It's going to happen soon. It's ready. It's time. That's what anchor bars and zones are all about, right? That's what supply and demand on the chart is trying to figure out. Where should I expect the buyers to come in? If I expect them to come in at this area, okay, and my price happens to be right there right now, then I have to expect if that's really where they're going to come in, they're going to come in soon. Okay, they're going to show up. The cavalry's going to ride to the rescue. Either they are, or it's going to be Custer's last stand and you're going to go down to the last man. But one of them is going to happen soon, right? It's either going to come out of there or it's going to drop out of there, one of the two. And either one's fine. You just don't have to sit there forever and risk the black swan. Okay, so the ideal place to enter is when you believe the stock is at a point where it's going to move. That's an important characteristic that nobody talks about. For me, it's important. It's one of the things I've identified as a way to outperform the markets without as much risk. I only go in at places that I believe that the stock has the ability to move and move soon. So I don't have to hang around too long. That's number two. Number three is the probability of success. Now, when I first wrote my first book, I said that was a much more difficult thing to measure. And it was. And one of the things I did with the last two books was to do a lot of analysis to try to understand what that probability of success is, and especially with the trend trading setups. That book is all about the probability of success. When are my probabilities the greatest? I just talked about this case on the SPY where do you worry about it? Well, breaks of two swing points on the same time frame gives you a little bit higher probability that you're going to do a fast move down. Breaks on multiple swing points on multiple time frames gives you a higher probability, a very high probability, especially on the downside, that you're going to get a fast move in the direction of the break, and it's going to happen right away. Matter of fact, it's like almost a 90%er. So if we get back down to here and we have multiple swing points on multiple time frames, which we would, and let's say we come down there, the way you come down is important too. The situation I described, you go up, you come down here, you do the retest, regen back up, but you can't make new highs, or you make nominal new highs and you fell and you come back. Okay, now you come back, you break here and you break down fast or something, you get in here and now you go sideways for, a week on the daily. That's a dangerous situation, right? Because now you're sitting there, swing point low on this time frame, swing point low on the intermediate term time frame. If you break those, the odds of a fast move down in the direction of the break is extremely high, right? And that's the sort of thing you have to be aware of, and that's where you have to put your protection on. Either you get out of stuff and go to cash, right? Or go greater to cash, or you do that with inverse ETFs, or you simply buy into inverse ETFs and not move anything around and protect yourself that way. But you have to, the whole thing, it's all about protection at certain points in time, depending on how much risk you're willing to take at any given time. That's what it's all about, right? It's about ebb and flow of the markets, looking at the events that are shaping up on the shorter term time frames to allow you to manage your shorts, right? Not your shorts, your portfolio in a way that you have less risk. And the question that just popped up, why not short? That is what the inverse ETFs is, right? You can use those. I prefer to use the inverse ETFs anymore versus outright shorts against individual companies, because that way I just spread the risk across the whole sector. If I'm an inverse sector ETF or inverse market ETF, it's across the whole market. You could individually short if you want. I used to do that because there used to not be inverse ETFs. But now inverse ETFs will allow you to protect IRAs, right? Where you can't go short. You can still protect, which you couldn't do before. There's more tools out there now that'll give you the ability to smooth your returns than ever before, right? To avoid huge losses. Before you had to go to cash, there was nothing else you could do. Now you can inverse ETF things in things that are not even margin accounts like IRAs, right? 401k type stuff. Although 401ks mostly don't give you an inverse ETFs, most of them don't. So you have to go to cash still in those. Okay, hopefully that's good for that. Now let me just try to take some individual questions. Boy, this is taking more time than I expected. Is this good? Is this valuable? Hopefully yes. So I spent a lot more time here than I thought I would, but you know, that's me. I talk too much when I get going. All right, let's see here. Let me just flip through. I'm just going to flip through the pages here and try to take out some individual stuff. I can already see we're going to have another session. So we'll plan another one because I haven't even got the trade signals or anything yet. So let me just try to hit questions. And matter of fact, I'll try to hit the questions, and that way if you have additional questions, you can email me and we can use those in the next one as we try to move on to other stuff. So what are the, let me see. Let me jot through these real quick. So okay, so there was one question here about, you know, entry exit strategies. I think I just covered that pretty well. And really I'm using anchored support zones as my mechanism for entry and exit, right? And that's, to me, because I'm doing that for those three things I just talked about. I have lower risk, higher reward, right? And I only want to go into those that have that. I have a greater probability of success, and it's probably going to move right away. That's what I want. There was also a question about when I look at stocks, how do I decide what stock I want to go into? And that depends on your portfolio. And what I mean by that is, if I'm in the investor portfolio, I want to look at the trading cube. All right, let's pop over here. Let's go get the trading cube up right quick. And let's take something that's in that had been in the portfolio, like eBay. Right? Let's just take eBay. eBay extended on the intermediate term time. It was very extended on the short term time frame as well, right? And that was one of the reasons we got out of it. And so we have extension on the long term, right? MTTF, in case you don't understand this, MTTF, and there was a question about it as well. It's the cumulative probability of a failure of trend on that time frame. When it gets up into about the 70% range, it's starting to get to the point where you have to be concerned about it, right? Doesn't mean that thing's going to fail. It's just a higher probability that it will change trend. Now recognize, if it's a bullish trend, change trend simply means it has to go to sideways. That doesn't mean the trend's ended. What I mean is the long-term trend, right? Because, as a matter of fact, here's a good example of it. This was extended on a bullish time frame not that long ago, back here. What was this? Back on 12/4/30. No, that's not true. That's the wrong one. Intermediate short term. It's too far back now. It's already fell off. But you know, a month ago when we started getting worried about this thing was extended. It was extended on the intermediate. It was extended on the short term, and it was so on the long term. Now it's turned bearish, right? 3 times over now on the short term. On the intermediate term, though, it's still extended, but it's still bullish. And as we just saw in the chart, it just flipped back around. It's going to go to sideways and probably going to push up to bullish again before it comes back again. This still is a range trade, even though they just had that big pop up, and they'll probably do the ABCD up. That chart probably is still going to consolidate, and I would think it consolidates for 3-4 months at least. And that will give the bullish, you know, it would have to reset this for me to really get excited about it again, because then it would have the ability to go a long term again. So, you know, that's the way I look at the MTTF and why I look at it. Now, the other thing I came in here for wasn't that. It was for what do I look at for a long-term portfolio versus a short-term portfolio. At the time, eBay, when I first got into it, eBay was double-digit on both revenue and earnings. And they were both at about 25-30% clip, I think. They were fairly high. Institutional holdings were very good, right? It was a big stock, had great growth, big cap stock, had great growth, had a lot of institutional support. And those are the things I look at. I don't look much at the PE. I look at the dividend for the investor portfolio for dividends, because I want to hold dividend stocks if I can. You know, it's an added benny. But I want the revs and the earnings to be strong. Most all the stocks I put in there, that's the case. Not all the way, not all the time, especially if I'm under the gun like I was back in January and had missed being positioned as long as I wanted to be. Sometimes I'll reach for things like ETFs, even in the investor portfolio, right, to get short-term exposure, to get my overall portfolio higher in terms of percentage holdings. And I just don't have a good spot to go into some of these stocks that I want to be. And that's okay. You can augment your portfolio that way. Okay? So that's what drives me to get into those. Okay, so here's another question. I would be especially interested in how you use the trading signals to hone in on specific trading ideals, right? And I just see a question pop up here. How do I go through each night for potential trades next day? I really don't go through them at the night. I go through them the next morning. The reason I do that is because I use this. Okay, so I go in here, and I only do this when I actually want to get into something. I don't do it every day, because every day I don't always want to get into something. I might already be into enough stuff that it doesn't matter. And so usually what I will do, if I wanted to buy things now, I would want to look at either bullish breakout or bullish retrace. Now, which one do you look at which time? Late in a move, I'm not interested in breakouts as much, right? I probably want to steer away from those. I want to buy retraces. Why is that? Well, because late in a move, there's more failed breakouts than there are successes. And breakouts already have a bad probability of continuing, okay? So, and a good example is, I think we took CGI, and that thing's gone nowhere. It failed on the breakout. It's doing the retrace, retest, regen. Late in a move, breakouts habitually fail. You don't want to chase those things most of the time at the end. You want to do those early in a move. So when the trends have just changed from a sideways to a bullish on the intermediate and short term, for example, and it looks like they're going to continue, and maybe you got multiple swing points breaking on multiple time frames across sectors and stocks, that's the time you want to buy breakouts, right? When you don't see that, right, you usually want to go for your retraces. So if I'm looking for retraces, I pop in, I go to the retraces, and I start doing these. Now, what do I do with them? Well, the first thing I do is I pull up 3 of these charts. I have one on each time frame, and I have them just laid across my screen, right? So I'm sitting here, I'm looking, let's just take AOL. So I'm sitting with 3 of these charts, and I pop into AOL. I look to see what it looks like on this time frame. Is it at resistance, blah, blah, blah. Okay, so this one's got some great 3 bars here on the way up. It's into the top one. This isn't much of a retrace yet. Okay, so it's coming back. You know, it's close enough that it triggers. Okay, let's look at the weekly. I look at the weekly, nah, that's not bad. It's coming into an anchor zone here, right? So this area is an area I'd be interested in if it came back to. Okay, so how far is it away? How close is it? If I go back to the cube, I can see, do I have the cube up still? Here, let's go get the cube. If I go back to the cube, and I flip down here, I can see that the average true range on a short-term basis, this is the daily, it's going to move $1.38 a day on average. Okay, how far is that down? If I go back to a daily, look at it real quick, we're at 90, what are we at, 38.14 in that area that I'd be interested potentially would be here, 36, so you're close enough, right? It could move there in one day, on average. Okay, so that one I put on my list for the day. I just jot it down somewhere, right? Throw it in a file, do something with it, right? Go to the next one, right? That one looks okay. Go to the next one, BV. I do that for each one that's in here, right? And I already have a list that I've kept from yesterday and the day before. And what I'm doing is I'm trying to find the best one. What's the best one? Well, that comes with experience. You know, if I look at the next one on the list here, BV, that one doesn't look so good. I'm not that interested in this one. You know, in a move that's been this strong, why would I want to buy a stock that looks like this? I see no reason for it, right? So that's the sort of thing I'm always doing. I'm looking to see what's the strongest stock I can find that's doing some sort of a retrace in a bull market move. And if I'm in a position to where I want to add more exposure to the portfolio, I'm going to try to pick 1 or 2 of those. Now, once I get that list of say 10 or 15 that the TAs look good, right, the technicals look good, then I want to go back over here into this guy and say, okay, what's the earnings growth and the rev growth? Are they negative? Are they making money? Are they expanding their product line? Are people buying them? If they are, then I'm more interested in it. And one of the things, I've been building is a database that gives me a trend of these things. I don't have that up for you yet, but it's something I'm building and working on. I'd like to know that the trend of that is up, not just the one number, but the trend. What's the trend look like for these things, right? So those are the kinds of questions I go through. I also pop over, I look at the news if I'm really interested to see if anything particular is going on with it. I want to know what sector it's in. Is that sector supporting it? Remember, you want a strong sector. That's what the cube's all about. What sector is this guy in? He's in the XLK. What does that sector look like? Is it extended? Right? Those are the sorts of things I look at. That's how I go about trying to decide, do I want to buy, what do I want to buy when I want to buy something? And I want to go find the best stock, 2 stocks, 3 stocks at the time that I believe have the highest potential to return something to me right away. That's what's going through my mind. That's how I'm finding them. So I'm using the signals. The signals are trying to generate ideas for me. I keep a list of those, right? And I've been thinking about how can I keep a list online, that you could keep a list online, maybe with the history of when it fired, those sorts of things. Those are all the kinds of thoughts that as we continue to build out these tools, that will give you a better way of managing, what you want to go after. In other words, there's no reason that I throw these signals away every day. We could just store the signals, and you can have an easy reference of when that signal fired, the last 5 times or something, right? To give you a sense of, boy, this one's firing over and over. This is a good one. So, all right, let me answer a couple questions here in the last couple minutes, and then I have a lot more to do, so we'll definitely have to have 1 or 2 more sessions. So how do I go through each night? Okay, so I go through during each morning usually. I do have, of course, the watch list that I already have. If I'm wanting to add exposure, I'll flip back through it. You have to call those all the time. Watch lists are a pain because they're a lot of work. That's one of the reasons I moved to this whole idea of signals, so that I could get fresh ideas every day, right? And if I need to move into something, I can just reach for something that's there and readiness now, without having to try to maintain a bunch of lists, right? Yeah, I still maintain a list, but I try not to, because it's there's certain stocks that really stand out that you don't want to forget about. But the hard thing about watch lists is you're constantly, one day you wake up, you see, like AOL, let's say it was great, all of a sudden it's up 20%. Oh shoot, I forgot about it, right? How many times does that happen? It happens all the time, right? What you'd really like to do is to have the watch list pop them up. As a matter of fact, one of the things I'm going to work on next is trying to make these potentials more proactive. Right? These are things that are right at the point where they should do something. And I don't know what these look like, but let's look at let's just look at the first one, CHY. See what it is. How do we know what it is? Okay, so this one has the potential to break out. Swing point high here, right? It's right at it. Matter of fact, it looked like it got over it. I can't tell, but anyway, this was from, yeah, no, this is that one. So the close is 1281. The close over here is the high was 1280. That actually looks like a breakout. Are these signals today's? 29th? What is today? Oh, that's why. No, it should have shown. Okay, I don't know. 1281. Well, anyway, it meets 8 of the 10 possible criterion. Another thing, an enhancement here, is to tell you which 2 it didn't meet. I'm not doing that right now, but that would be something to do. That particular one I don't quite understand. That one should have already fired instead of being a potential. Oh, here's another one right here. That's why. See, you can't doubt the programs. There's another one that's about to fire. So that's multiple swing points, multiple swing points on the same time frame that are about to fire. There's one here it just fired, one that's about to fire. That's why it's showing as a potential. Okay? So a lot of times, if you want to do your work nightly, right, you can take the swing points that were potential, right, and you can use that, and you can review what happened today to all of these stocks to see if there's still potentials and still ready. Okay? So that's one way to do it. How much do dividend factors into your decision on purchasing if you're a long-term investor? For example, The NRP paying 10% with a possible breakout. Well, yeah, it factors in. You know, I have a very hard time with all these pipelines and stuff, because when those guys correct, they get slaughtered. Here, let's look at NRP, and I'm still struggling with this. You know, and how do I do this? So like when they correct, I put it on like a weekly or something, they tend to correct huge, right? I mean, this one actually has been in a downtrend and now it's breaking out. But you know, from here to there, right? 22 to, they just all, most of them, if you go look at them in the cubes, let's pull the NRP up. They have large drawdowns, right? In you know, relative to what the price is, and I need to probably put a percentage up here. That would also be good. Maybe a percentage out here as well. So you know, I have when somebody's paying 10%, just like when I look at reward risk, a lot of people say you want 10 to 1 or something. That's bull, right? You're not going to find any more 3 to 1, 4 to 1 most of the time, right? If it was 10 to 1, it's really 10 to 1. Believe me, everybody's already over it. They're all over it already, right? So, you know, your numbers just aren't right. And somebody paying 10% dividend, well, something's not right there. It just raises a red flag to me. So I get a little bit more worried about it. But, you know, maybe I just don't understand it well enough. So, I mentioned that one because it looked interesting. It looked like it could run and was paying a great dividend. But I actually didn't buy it for myself. When you are interested in bullish, when are you interested in bullish breakouts versus retraces? I just said that a second ago. I'll repeat it. As a move is becoming much more mature, like right now in the SPY, the move is mature, right? This is not early in the move. Remember, from here to here is about 200 points. We're already done 200 points. Matter of fact, if you pull this in, you put it on a daily, and you look at it, you just extend it again up to an area. Now it did consolidate and break out, and it could be the beginning of another leg up. But you know, for the most part, this thing is fairly extended. It's extended on the weekly. It's extended on the daily. When I see something like that, right, on the extensions, I don't want to buy breakouts towards the end or potentially the end of a move. They're going to fail at a higher rate. So I want to buy breakouts fresh in a move, young in a move. Like here would be a nice breakout area, right? A breakout in this area, or a breakout over this, well, that wasn't a good one, but a breakout over here potentially, although that one was fairly extended already. You already had a pretty big move. You want it fresh, you want it young, you want it when it's just starting to happen. And that's across multiple time frames, right? If the move is young, let's go to the SPY here. If the move is young in terms of the MTTF, right, it's not a bad idea. This is long in the tooth on the long term. Fairly new here, not too bad here. So breakouts still may work now coming out of this consolidation. It's just that we have been going up for a long time already, right? And you can see it here like in the NASDAQ where we haven't had the resets. I mean, look at NASDAQ. That's about to change, but you got 61%, 66%. This is long in the tooth. We're late in the move. This is not early in the move. So I get more and more cautious as these get longer, I get more cautious, right? I mean, we're almost nosebleed on the long term. That makes me more cautious. And, you know, breakouts tend to fail more at a higher probability the longer a move has gone on. And certainly the long-term move has gone on for a long time now relative to what the average is. All right, folks. Well, that was good. I didn't get nearly as far as I had hoped. I'll do this again, and I'll better organize the notes. I didn't do that probably as well as I should have. Send me more questions if you have them. I'm going to archive this so you can review it, and I'll leave it at that for today. Thanks, and I appreciate it, and we'll probably do another one next week sometime, and maybe Saturday again because that seems to be a good time. We'll see. And I'll ask people that weren't able to show up live and see what you know, is there a better time for them as well, or is the archive, maybe the archive stuff just works well. So thank y'all. I appreciate it. And have a great weekend. Have a good Easter. Bye-bye.